I mean, I've been in Africa for the last 15 years, and I can tell you now, one of the most important things you got to understand from day one, Michael and Tim, is you got to know how to acquire customers in a smart way without spending hundreds of thousands, if not millions of dollars in Facebook, Instagram, Google, TikTok, you name it. Because the reality is, it is hard to acquire customers from a B2C and D2C perspective. So, really smart entrepreneurs understand the subtle art of sacrificing a little bit of margin for volume.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, our guest is Zachariah George of Launch Africa Ventures, and he is the epitome of advancing VC. Zachariah, thank you for joining us.
You're most welcome. Glad to be here.
Can you talk about how you got to inception to Launch Africa?
Yeah, it is quite a long, circuitous path. So I grew up in the Middle East with two mixed parents. Got my MBA from Stanford several years ago. Well, 21 years ago in 2004. Post Stanford, I went and worked in Wall Street for a long time. I was at Lehman Brothers in New York until the bankruptcy, and I was at Barclays for a couple of years. So, but the one thing I sort of realized during my time on Wall Street was, although we worked crazy hours, did a lot of really cool deals, there was very little impact in what we were doing. I couldn't see the bigger picture beyond just making corporations and very wealthy individuals and family offices even wealthier. And I was intellectually curious about Africa for a very long time. My father was born in Tanzania and grew up there. I've have tons of my friends that are from the African continent that are now part of the African diaspora, and I was just, like I said, intellectually curious about why you'd had accelerators, venture builders, startup studios, and eventually VC funds in a lot of emerging markets, including India, Southeast Asia, Latin America, and for some reason, Africa was never part of that story. So in 2010, whilst I was still a banker at Barclays in New York City, I decided to take a very brief sabbatical in May of 2010, and I came to South Africa. It was very convenient. It was very pleasantly convenient that the World Cup, the soccer World Cup, was also happening in South Africa then. So I came here, watched a few of the games, and I just said, "Gosh, there's so much in a city like Cape Town or Johannesburg. There's so much talent, raw talent, be it devs, designers, people in media, marketing, advertising, UX, UI. But there was just no infrastructure to support these founders, and very little work that the big universities and research centers did to take these incredibly talented graduates from master's and PhD programs and encourage them to start their own companies and not just go and work for large corporates or go into academia. So I decided to do the almost unthinkable. I quit my Wall Street job, decided to pack my bags and move to South Africa permanently. I then traveled all across Africa for a couple of years, including a stint as a professor in Kenya for a little bit. And eventually, what I did is I started building venture studios that could get the top students out of Africa's best business schools and technical schools and almost plant the seed of creating something like a Y Combinator or a Techstars or a Rocket Internet kind of model, but focused on African entrepreneurs and getting them access to large corporates and getting them distribution. And that was eventually what became the first ever accelerator in Africa, which we called Tech Lab Africa back in 2016. And that, sorry, 2015, sorry. And that was eventually acquired by Barclays Techstars. And that literally opened the floodgates into the concept of venture building in Africa. And eventually, Startup Bootcamp, which is one of the biggest accelerators in Europe, often called the Y Combinator of Europe, ended up coming to Africa and asked myself and at the time my co-founder Philip Kirikoff to build Startup Bootcamp in Africa. That was the first ever global accelerator on the African continent. extremely successful, returned all capital to its LPs, triple digit IRR. And that was then what led me to say, okay, if we've now built accelerators across Africa, the next logical step is to build an early stage VC fund. And that was, in short, the birth of Launch Africa. And Launch Africa today, 5 years later, is the leading early stage VC fund in Africa. It's taken a lot of hard work to get there, and I'm happy to share specifics about how we got there, but that was the whole thesis of providing institutional grade capital to early stage investing, which until that point was predominantly just friends and family and a few angels. And now it's sort of been formalized through an institutional framework.
One of the things that keeps me energized about entrepreneurship is that, and even in the roughest days, right, when we're all getting punched in the face and stuff isn't working out, and business models are shifting and markets are going away, right? There's no shortage of great ideas in the world, right? And there's no shortage of founders willing to go after and tackle those great ideas. So before we even get into the investment aspect, can you bring us into what does venture look like on the ground? What does the ecosystem look like on the ground for African entrepreneurs? And I want to give some context here. My master's was actually in American studies. So I study a lot of television and stuff, etc. And you know how Africa is portrayed in film, right?
Oh, yeah.
Machetes, warlords and stuff, etc. And then people go on the ground and they're like, it's nothing like this. You know, what is that misconception that we have in terms of entrepreneurship, and what is the reality on the ground, particularly with regards to venture backable startups?
Listen, that's a loaded question. I could speak for literally 2 hours just on that one question, but I'll try and do it in a couple of minutes. The reality is, without being controversial here, there's a lot of money to be made in keeping Africa poor, or at least keeping the concept of Africa as a poor continent, right? There's a lot of money in poverty. I'm just going to call it for what it is. All the big foundations, charities, philanthropies that do amazing work in Africa, unfortunately, from an efficiency perspective, are horribly, all things being equal, inefficient. A lot of money gets siphoned into consultants and OPEX and, paper pushing, I don't know, organizations. I mean, the actual money that goes into beneficiaries is often in the single digits or very early double digit percentages, right? So I don't think the true impact of venture philanthropy or charity or aid organizations in Africa is even close to what it was supposed to be. I'm going to leave it at that. It's a very political topic, but what the reality of what is on the ground is Africa has just as much talent from a raw tech, design, thinking perspective, marketing, sales, finance, you name it. It's just that a lot of these entrepreneurs, I mean, think about it from a cultural and historical and anthropological perspective. The first real regions or countries in Africa post colonialism only had the light of day for these sort of young entrepreneurs in the sort of late 70s to early 80s. The first generation of young entrepreneurs only had the opportunity to go to school and universities a couple of, well, I'd say about 10 years after the fall of colonialism. So we're talking like 70s to early 80s. Now, it is really hard to think of someone wanting to go and build their own business when they have so much soft debt, often called the black tax in US circles, where they would either go work for the government, the civil servant, or work for a large corporate. And it would ultimately take at least a generation, if not likely 2 generations, for someone to say, okay, I've paid my dues to my grandparents, my uncles, my aunts, my parents, etc. Now I can go and take risk capital to go and start a business. So when people throw this out there saying, why don't you have why don't Africa have a lot of entrepreneurs in the 80s and 90s? It's a really stupid, backward, almost ignorant question to say, right? It's like saying, why didn't we have more, I don't know, black entrepreneurs in the US in the 70s? I mean, no shit, Sherlock. It was the civil rights happened just a few years before that. So you have to apply things in the right context. Now that you've had at least 2, if not close to 3 generations since the fall of colonialism, now you have the risk capital, time, and resources where the current generation of Africans have either come home from the diaspora in Europe or North America back to Lagos, Nairobi, Kampala, Accra, Johannesburg, Cape Town, etc., and have the time and energy and resources to start businesses with risk capital that they now have. So venture in Africa really started taking off at best about 10 years ago in the early 2010s. I'd say closer to the 2015s. And that's when you had really smart founders in Nigeria, South Africa, Kenya, and Egypt, the big four in Africa, join accelerators like Y Combinator, 500 Startups, Techstars, Startup Bootcamp, etc. And today, 5 to 7 to 8 years later, are now doing A, B, and Series C rounds and are now being champions of industry and are encouraging the next generation of founders to follow in their footsteps. But remember, until about 7 or 8 years ago, none of these young entrepreneurs in Africa had an African champion to look up to. It was always, hey, one day I want to become Jeff Bezos. I want to become Mark Zuckerberg. I want to become, Brian Chesky. But where were the local African entrepreneurs to look up to? They didn't exist because you have to apply the right historical context here. But today, post COVID, you have 7 to 8 to sometimes 10 years of history, and people can say, I don't want to just become a banker or a lawyer or an architect, nothing wrong with those professions, but I want to start my business because, Ionola Abuyeji built Flutterwave, or GB built Andela, or um, I don't know, Katlego Mapai built Yoko. These are companies that people can relate to. So you have to apply a cultural demographical context into the VC industry. So at best, venture in Africa has truly reached, or it's sort of gotten past the sort of starting blocks in the last 7 to 8 years. But you'd be amazed that just in the last 10 years, we've gone from about $50 million in venture capital in 2015, give or take a few million, to now almost 6 billion in venture capital as of last year. So the rate of acceleration of venture capital funding, although starting from a very small base, is growing faster than anywhere else in the continent, in the world. So that's sort of the background perspective. And it's happened in a very short period of time. Um, Africa had 0 unicorns 6 years ago. Today we have 15. So you got to always think about. My dad's a macroeconomist. He was, with the IMF for many, many, many decades, and he often says, "Look at the tea leaves. Look at macro, macro, macro." Um, Africa today is about uh, almost 20% of the world's population, but we only have about 7 to 8% of the world's GDP. So there's a huge arbitrage there. And then we have about 1 to at best 1.5% of the world's venture capital. So that's a double arbitrage that is shortening and becoming more efficient every year. So it's a question of when, not if, that arbitrage closes.
It's interesting you made the comment about 10 years because one of the things that I moonlight is I recently went to the African Business Conference at Columbia Business School.
Yep,
You're
I
starting to
attended that.
see these pop up at all the different MBA programs, and the level of talent that is hungry about going back and supporting, building infrastructure in Africa. I don't think a lot of our viewers will realize, but at our elite business schools across the country, huge chunks of people from the diaspora that are attending these schools and these programs. So that makes a lot of sense, kind of coinciding with that. And so there does feel this energy. And when I was at the Columbia, they were hungry, they were proud. I bought books, they had vendors. It was absolutely amazing. Now, one of the things as an entrepreneur here in the US and traveling, being able to travel, we have a lot of infrastructure here. You can, any city, any state, etc., you can always find an incubator, an accelerator, a program that's going on. That's one of the things I wonder about in continents like Africa in terms of access to the everyday like person. If I come up with an idea, whether I don't go to some elite business school or something, etc., where am I going to learn the fundamentals of entrepreneurship? And then how am I being able to tap into that infrastructure to get follow-on capital, whether it's VC, etc.
No, it's a fantastic question. I'll give you some real world examples. Mark Zuckerberg has visited Africa several times. Jack Dorsey's been to Africa several times. There are incubators, co-working spaces, venture studios, accelerators all over the continent. I'm talking, I mean, the big hubs are obviously Lagos in Nigeria, Cairo in Egypt, Nairobi in Kenya, Cape Town and Johannesburg in South Africa. But it's exploding, guys. There's Dakar in Senegal. There's Casablanca in Morocco. Of the 54 African countries, I'd say about between 22 to 25 are really active. Um, I mean, Zuckerberg and Dorsey, when they were here a few years ago, were completely surprised by the level of pure tech talent. I mean, you walk into a cafe in Lagos and you don't see people sipping their skinny lattes and talking about the weather. These are people writing code and building tech, payment companies, e-commerce, Shopify equivalents, building companies that do last mile delivery, logistics. People are out there hustling. And necessity is a mother of, I say, innovation, not just invention. And because it is so hard, when you come from absolutely nothing, you learn to hustle your way through from a very young age. And that's something that hunger and fire that I don't see in San Francisco. I don't see it in Berlin. I don't see it in London because you've got plan B, plan C, plan D. You've got daddy's hedge fund to join if you don't work out. You've got the family business. You've got uncles and aunts that can help you get into insurance companies, banks, manufacturing, telcos. In most African countries, if you don't succeed, you don't have an option, so you make it work. And that hustle is very similar to what I saw in markets like Singapore, in Indonesia, in Mexico City, in Bangalore. I'm seeing that hustle in Africa, but you have to learn to work smart, not work hard. So one thing I mean, I've been in Africa for the last 15 years, and I can tell you now, one of the most important things you got to understand from day one, Michael and Tim, is you got to know how to acquire customers in a smart way without spending hundreds of thousands, if not millions of dollars in Facebook, Instagram, Google, TikTok, you name it. Because the reality is, it is hard to acquire customers from a B2C and D2C perspective. So, really smart entrepreneurs understand the subtle art of sacrificing a little bit of margin for volume. So they go and work with the large corporates. The large corporates in Africa are extremely powerful. They almost function a bit like oligopolies. So you've got 5 to 7 big insurance companies, 5 to 7 big telcos, banks, and retailers all across Africa, obviously through their fully owned subsidiaries. And you got to understand that it is so much more efficient to do POCs, proof of concepts, and pilots with these large conglomerates. And then you can acquire customers at a fraction of the cost that it would be for you to do it yourself, right? And if you look at the most successful startups in Africa in the last 10 years, not just the unicorns, but even the ones that are $100 million or more, 90% of them are B2B or B2B2C, which is exactly opposite of what you'd see in a San Francisco or a London or a Bangalore or a Tel Aviv or a Berlin, right? And that's the same thing in Latin America, right? In Mexico City, in Rio, in Jakarta, right? So that really changed. And corporates in Africa for many years completely ignored startups because they said, hey, why do I care about startups? But the reality is, startup founders understand the customer sort of behavioral patterns of Gen Zs and millennials much better than any corporate. So it's this subtle blend of the startup founders holding on to the tech and the IP, but the corporates providing distribution and know how, which really converts a simple startup idea into an executionable and monetizable commercial avenue. And that's what we've seen grow exponentially in the last decade or so. Obviously, leading with fintech and payments, and I can talk about that later down in the show.
Yeah. That was going to be one of my questions in terms of, because you talk about the hustle it takes for the founders. I can only imagine the hustle it takes for the venture capitalists to get a fund going, because again, going back to stigma, microfinance is typically when you think about emerging economies, less of like venture backable tech. So I would love to learn about the scrappiness it takes to launch a fund in Africa, and then how you've evolved in terms of the money you put into the founders, so check size and stuff, etc.
So the first real private capital in Africa started with private equity in the 90s. going into the 2000s. So private equity uh, has been sort of the major source of funding for infrastructure projects in Africa for the last 30 years or so, but it's mostly gone into traditional industries, if I may call that. So oil and gas, manufacturing, mining, minerals, agriculture, right? So it's either debt financing or mezzanine financing, and to a certain extent, some amount of equity, right? So private equity and debt financing has pretty much ruled the roost in Africa for the last 3 decades, right? Venture capital as an asset class, until about 10 to maybe 12 years ago, was relatively unknown and unheard of, right? So what really changed was consumer purchasing power in Africa was the single biggest reason why venture had no place in Africa until about 10 years ago, right? Because if consumers don't have purchasing power, you can build the best product. If no one's going to buy it, what's the point? And that's what VCs fund, right? So three things happened about 10 to 15 years ago that really changed that. One is mobile, right? The telcos in Africa, extremely powerful. And from a tech perspective, far more advanced than any telco anywhere in the world. You probably heard of M-Pesa and all the big telcos in Africa. So the cost of data in Africa used to be exponentially higher than anywhere else in the world. I remember when I first came to South Africa in 2010, the average cost of mobile data, so 1 gig of data, was around $50 across the 54 countries, right? Well, 55 at the time before Sudan split. But it was about $50 for 1 gigabyte of data. I mean, how do you transact if the cost of data is that high, right? So all the telcos in Africa got together and said, we cannot build digital commerce in Africa if the cost of data is that high. Over the last 15 years, the average cost of data now in Africa is under $2, from 50 to under 2. So you've now suddenly opened a continent that has 1.5 billion people, right? The fastest growing continent on the earth, right? A very young population too. The average age in Africa is only 18. The average age in the US, I think, is in the mid 40s. In Europe, it's also the mid 40s. In Japan and the Far East, it's in its early 50s. So we are the youngest continent by far. And the youngest continent that's also the most digitally savvy, because young people are more digitally savvy than older people. So you have this sort of perfect storm, right? You have an increasingly lower cost of connectivity, a very young population growing quicker than anywhere else in the world. And number three is just the penetration of smartphones. I remember when I came to Africa 15 years ago, there were more mobile phones in Manhattan, not New York, not the US, in Manhattan, than the whole of Africa. Right? Just sit with that for a second. 15 years later, there are more mobile phones in Africa than the whole of North America, that includes Central America and the Caribbean, in just 15 years, right? So you have this increase in mobile, and everything's done through mobile. If it's grocery, food, pharmacy, learning, healthcare. So you have this young population growing very quickly. In the next 20 years, Africa will have 12 of the 20 largest cities in the world. Kinshasa, Nairobi, Johannesburg, Cairo. It's not going to be just the Tokyos and Mexico cities of the world. So a very fast growing population, low cost of data, huge penetration of mobile phones, a young population. And what does that create? High consumer purchasing power. And that's what VCs love. So the addressable market for any technology, be it in drug distribution, e-learning platforms, last mile deliveries, AI into factory inventory management, anything, as long as the customer purchasing power is high, you cannot ignore those markets. And that's what's been happening in Africa for the last 10 years. And that's why we decided to plant ourselves on the ground in Africa 15 years ago, knowing that in 10 years, no one's going to be looking at, small cities, or sorry, cities in Europe or in North America for consumer addressable market sort of analyses. You're going to be looking at Africa. There was a famous quote that the founder and CEO of Nike said on an interview, saying, "Who's going to be buying sneakers in the next 10 years? It's not folks in Cape Cod or in Rhode Island or in Monaco. It's young kids on the streets in Nairobi, in Lagos. So unless you have Africa with 1.5 billion people growing faster than any continent in the world as your target market, and you start building ventures in Africa, you're missing a trick. And we're hoping that us being here on the ground for the last 15 years and growing is the right attitude, but it's also the right thing to do from a business perspective.
What you said makes complete sense too, because I'm not to get political here, but obviously we have a lot of culture wars here in the U.S. And one example is, Bad Bunny and the Super Bowl, right? What a lot of people don't realize is that a lot of these corporations here in the U.S. are trying to attract global reach, you know. And you see the NFL, you see the NBA doing more activations and stuff in Africa, and I think it speaks exactly to that. We got to think about this kind of global reach and this global impact. Same thing with media. I've been following Justin Norman with the Flip podcast for many years. He had an episode that the future of work is bootstrapped, and it spoke exactly to what you talked about, where in Africa, people got 6, 7 ventures. But,
Yeah.
people of color here in the US is kind of the same thing, but you got to understand the context, because even when you were talking about mobile first, I realized that, not everybody has laptops. Not everybody has desktop computers, but those mobile phones, it's not just used as like a mobile device. I mean, it is their personal business operating system. So you've got to understand the lens. And with that kind of probably guides your kind of investment thesis in terms of like, how are people actually using using technology? What is their day-to-day interaction with it? If you're not on the ground, laptops and things might make sense. But when you're there, you're like, oh, people, they're out here running around doing 10 to 7 different things. They need that mobile first.
Yeah, and you touched upon something very relevant, and that's data, right? So we've been doing venture in Africa for more than a decade. My co-founder Junaid was the chief investment officer of the African Development Bank, which is the World Bank of Africa, for many years. He's run 3 funds before this. I've run a fund before this. So this is now our 6th fund, and our second fund together. We have so much data on private capital markets in Africa. We've looked at almost 10,000 entrepreneurs over the last 5 years. So everything from margins to transaction volume to average gross margins in multiple industries, take rates. We have so much data, and data is the new oil, right? You're not going to find information on, for example, invoice discounting rates for corporates in Africa and SMEs. You're not going to find information on average net interest margins for digital unsecured lenders in Africa on Bloomberg or Reuters or Factiva. It's private information that good venture funds have access to, and you trade on that information, right? So we have such rich data, which we then use to make investing decisions, right? So I often say, I mean, I think venture capital on the African continent is. I'm not saying it's a panacea that can solve all problems that we've had for decades, if not centuries, but it is one of the only ways in which you can encourage founders to build products without seeing any notion of race, religion, color, nationality, or gender. Technology cuts across all of that. If you can build something that has good product market fit that someone will pay a price for and creates true impact, venture will fund that, right? And that's what we'll be doing. I'm sure we can talk about our fund specifically later on, but venture capital from a pure impact perspective, our fund alone has helped create more than 60,000 jobs in the last 5 years alone, right? And we've invested, and that comes from investing around $65 million, both our capital and our LP's capital. If you can name a single corporate or government, not just in Africa, but in the world, that can create that many jobs with $60 million of capital, I rest my case, as they say. And these are not jobs that are receptionists and janitors and low unskilled jobs. With all due respect to those jobs, these are jobs in development, in marketing, in sales, in coding, in robotics, in accounting, in marketing, in design. I mean, these are high skilled jobs that venture capital is helping create. without interference from large bureaucratic governments and corporates. So by all means, may it grow even bigger and bigger. And we need folks abroad outside of Africa to understand that this is a 100% commercial opportunity and not just a sob story of let's do some good in Africa and have a nice chat around the barbecue on the weekend. This is real value, real money, and real commercial upside with impact.
I'm gonna pass it to Tim, but I'm gonna give you something about us. So we invest heavily in veterans, military veterans, and in our community, veterans are also looked at a lot of times as a sob story, you know. But we have so much talent, so we empathize with you around that and kind of changing the face, just like we're changing the face of veteran entrepreneurship here in America. What you're doing with entrepreneurship on the continent of Africa, I'm super excited about, and I mean, I could talk to you for hours.
You've given us a sense for the size, scale, and evolution of startups and venture capital. Can you do the same for Launch Africa?
Yeah, absolutely. Yeah. So before Launch Africa, I built a fund called Startup Bootcamp that I mentioned earlier. Um, that was an accelerator fund. So we wrote checks of $20,000, similar to Y Combinator or Techstars, and we'd have an 8% stake in these companies. We saw almost 1,000 companies over 3 years. We funded 30 of them, so a cohort of 10 per cohort times 3 years. That fund is currently sitting at a 37x multiple on invested capital. That's a ridiculous return, of which we've paid out almost 10% of that in actual DPI, as they say in the industry, distributions. Um, uh, yeah, we then in 2019, early 2020, decided that once we'd built the foundations of accelerators in Africa, we would now build a specialist early stage fund. So Launch Africa was essentially a fund that would back the top companies in Africa coming out of both global, regional, and local accelerators and helping them get through the so-called valley of death between seed and Series A. Um, for the last 15 to 20 years, there's been no shortage of global VC funds investing in African tech, provided they were at Series B and later. So if you're doing sort of anywhere north of $10 million in ARR, right, at the very little, all the way up to $100 million or more, typically you'd have the likes of an Index, an Axel, a Sequoia, a Lakestar, a Bessemer, a Union Square, whatever, invest in you. Because at that point, if you're doing those levels of revenue and you've either broken even or are close to breaking even, you're comparable to any similar startup, a unicorn or a half unicorn in Europe or the US or Asia, right? But it's at the early stages where people just viewed Africa as being super risky for all whatever reasons. Sometimes a lot of it was, completely unjustified, right? So our thesis was Launch Africa would be a specialist institutional source of capital to back companies between seed and Series A. What does that mean? Companies that have had their tech and proof of concept validated through accelerators, right? And are doing anywhere from I'd say $20,000 to $25,000 all the way up to $100,000 in monthly recurring revenue, and take them through that valley of death to get them to Series A. There were very few funds in Africa doing that, and certainly not at the scale that we were. So we built a team of what is now 16 to 17 people, but spread across 20 countries in the continent, just actually a bit more. And we started writing checks into primarily fintech companies and then later logistics, mobility, agri-tech companies, health tech, and ed tech companies, but focusing on B2B. So you had enterprise sales with large insurers, telcos, and banks. So sort of starting off with the low-hanging fruit and then proving that you could get returns, not just IRRs, but actual liquidity, because you're looking at businesses where the counterparties are big enterprises. So it doesn't matter if you're in Togo or Benin or Gabon, or you're in a Nigeria or a South Africa. If you're dealing with a big telco and can add value to them, it doesn't matter, right? So that was how we started. So in Fund One, we were looking to raise $15 million, 1 5, and we completely beat every expectation we had. We raised $36 million. But here's the interesting bit. We didn't go the traditional route in Africa where we talked to big DFIs like the IFC, the World Bank, or the DFC, or Proparco, or all the big sort of developmental impact oriented foundations in the world. We went to individuals. We went to people like you and I. We went to people to family offices, um, to serial entrepreneurs that had built similar companies in the US, in Europe, and in Asia. We set our checks to be as little as $50,000. So we had so many people that were hungry to give back, but really understand how to build venture backed startups in Africa. So we had more than 200 LPs in our fund, investing as little as $50,000 all the way up to a few million, right? We raised that in just over a year. We looked at just under 4,000 companies, all B2B or B2B2C SaaS companies across Africa, predominantly focused on Nigeria, South Africa, Kenya, Ghana, Egypt, but we also were the first institutional investor in a lot of second tier geographies like Morocco, Senegal, Cote d'Ivoire, Rwanda, etc. And yeah, we ended up investing in 133 startups across 22 different African countries. So we deployed about $31 million. And because our LPs were so hungry and intellectually curious about Africa as the next big market for VC, we allowed all our LPs to directly co-invest in our top performing companies without any fees or carry. So it was such a sweetheart deal for them. We did all the DD, financial, legal, operational, tech, and most importantly, human DD on the ground and through our accelerator partners, and they could get a free ride, right, as co-investors. So our LPs co-invested a further 17 million into our companies alongside our $31 million. And we did something quite unique as well, because we are breaking ground. We said that we're not going to have this traditional mindset where a VC fund's going to be 12 to 15 years from a lifespan perspective, because a lot of people were skeptical about Africa. So we said, okay, if we can show you that we can start generating returns in year 6 and 7 and not wait till year 10 to 12, it'll show people that there's a clear opportunity to recycle capital in an emerging market. So we're now at the sort of middle of year 5 of Fund 1. We've already had 13 1-3 exits, and we have another 5 planned before the end of the year. We're paying back capital to our LPs before Christmas this year, almost 10% DPI, which is better than most VC funds in the US and Europe in year 5 of a fund. We're currently sitting at almost 25% IRR and net IRR in the fund. But more importantly, we are, if you look at our failure rate, I mean, most VCs, irrespective of vintage, typically have failure rates of what, 50 to 60%, sometimes even more, and they bank on a handful of companies to create all the returns. Well, after 5 years, our failure rate is 16%, 1/6, right? The vast majority of our companies have gone on to raise future rounds of funding, be they seed extension, Series A or Series B rounds at higher valuations. 60% of them and about 25% of our companies are sort of flat at this point. And the reason those numbers are so good is because when you back smart entrepreneurs in an African country, I can almost categorically saying you're never funding an entrepreneur that's building something that's a nice to have. You're building something that solves a real world problem with tech. And I've given this example before. I've had the privilege to travel all over the world. I've been to more than 100 countries. And I can tell you now, you can see some really whack job companies in places like the Bay Area. I remember seeing this one company about 10 years ago that used drones, because it was the in thing back then, to deliver, I shit you not, organic smoothies to high-rise buildings in San Francisco just because they could, right? Serving a microcosm of the population, right? Raised 20, $30 million in VC funding because there's so much supply of capital. Served no real market and no real impact. And they crashed, burned, and died in a couple of years, right? Now, you will never see a business like that in Africa. Irrespective of what sector you work in, be it financial services, healthcare, education, agri, someone's using tech to solve a real problem, right? So the African equivalent would be, let's use drones to deliver ARVs to parts of a country that are not reachable by rail, road, ferry, etc., right? So almost every business we invest in, we now have 160 plus companies. I could tell you stories of real change through tech. I mean, that's another 4 or 5 hours of our time, but some incredible stories. And that's what we do. And that's why our failure rates are so low, because the stickiness of this revenue is so much higher than anywhere else in the world. And another last sort of little fun fact here before your next question is, in terms of success and failure rates, this is a stat that a lot of our viewers and listeners might find completely mind-boggling. Africa, from a venture perspective, is the one geography in the world that has the lowest failure rate of startups post Series A. Post Series A. So there's a lot of time, money, and energy and resources you need to raise capital and build a product market fit to get to Series A, which is typically when you're doing 10 to 20 to $30 million in ARR. But post that, the stickiness of that revenue is so strong because you're solving a real problem that it's an almost no-brainer. It's a no-brainer that these companies will go on and continue to prosper for several years until an eventual M&A or an IPO, right? The lowest failure rate globally post Series A. And that's so our thesis was, well, let's create more companies that are getting to Series A in 3 to 4 years and not 10 years. And that's why our thesis was, let's back really good founders at the seed stage and not have them spend 6 months of the year raising capital. We'll write them a smart check at seed, get our LPs to co-invest with us, and make sure that at Series A or Series B, we then get out. So that's liquidity for our LPs. And at the same time, now these founders are in much, I wouldn't say safer hands, but much better hands to now go to a global VC and continue their path towards profitability and scale.
That's really helpful to understand the state of venture, especially with what you're working on. I'm curious because you've been talking so much about exits. What does exits look like in Africa? Is it M&A? Is it IPO? And then it sounds like you have started from the ground up, venture studio, then accelerated a fund. I'm curious who are writing the follow-on checks on the Series Bs and Cs.
Yeah, so most of the B, C, and D rounds in Africa today are typically led by global VCs, and I'd say predominantly North America, well, the US, Europe, and increasingly Asia. That being said, there are a few Series B and Series C funds on the continent. So, for example, African Invest, Partech, TLCom. There are about, I'd say, about 10 to 12 really good late stage funds on the continent. And late stage VC and private equity in Africa tend to have quite a bit of overlap. But most of the major sort of Series B rounds in African tech are led by global VC. So, the likes of a Sequoia, an Index, an A16, or um, Visa, Head Sophia, Tencent, et cetera, et cetera. And there's a whole laundry list of these startups. Africa has 15 unicorns, right? And most of those B and C and D rounds have been sort of underwritten by large US VCs, US and European VCs. We have two unicorns in our fund two already. It's a fund that we're currently raising for, and our fund one has a company that's close to becoming a unicorn. What's really interesting about these unicorns is if you look at the average time that it's taken these companies to get to unicorn status, what do you think I mean, yeah, yes, it's a small sample size. It's 15 companies. But what do you think the average time it takes for a company in Africa of these 15 to get to unicorn status? What do you guys think it is? In the US, it's about 9 to 10 to 12 years from date of
Yeah.
inception. In Africa, it's about 4 to 5 years.
Yeah. And I have theory on that. I have a theory about everything you said in terms of why you are so successful. I think it's a self-selection process. I think in a continent like Africa, by the time someone's successfully able to launch a product in the market, successfully raise seed capital, successfully raise kind of follow-on capital, that's an uncommon human. That's our version of like an X-Men. So the talent that you're attracting is world class, I'm sure, because you wouldn't even approach a VC if you weren't.
Yeah, and spot on, Michael. And also what we're seeing right now. I mean, I'm a child of the '80s. I mean, I'm in my mid 40s now. When I was growing up in the '80s and '90s, there was this concept of brain drain. You probably heard of it before. A lot of kids from Africa, from the Middle East, from India, from China were leaving their home countries and going to the US and often Western Europe to go and study at Oxford, Cambridge, INSEAD, MIT, Stanford, Wharton, etc. What you're seeing right now in the last 10 to 15 years, it's so beautiful. I'm getting goosebumps even talking about it. Is you're seeing this concept of reverse brain drain, where a lot of these incredible diaspora founders, and I spoke of just on Africa for now, but the same thing applies to Asia as well in the Middle East, is there these are Africans that currently live in Houston or London or I don't know, in Berlin or in Chicago or Miami or wherever, and they're saying, wait a minute, I don't want to be another a statistic working at a big insurer or a hedge fund or an investment bank in New York City or London. I want to come back to Lagos. I want to come back to Nairobi. I want to come back to Johannesburg and build a startup that solves real problems for a continent. I can do that now in the last 10 years because there are the resources to build companies. There are VC funds like us and others that can fund that. There are corporates like Sanlam, Momentum, Standard Bank, EcoBank, MTN, Vodacom, big corporates that can help me with distribution. And I'm going to bring the smartest people that I know of back to the continent to build. And that's something to me is so beautiful to see. It's starting with the African diaspora, but I can tell you now, for shits and giggles, the next generation of African founders will not be Harvard, MIT, and Wharton grads. They're going to be grads from the University of Lagos, the University of Cape Town, etc. But you have to give it time for that to happen, right? So I'm really proud of having being one of the people that started the venture capital industry in Africa. But I think this is so much more than just returns and socioeconomic benefits. It's cultural. It's changing people's mindsets, and it's saying Africa is no longer the dark continent. It's not a place where you just park your $8 and get a nice tax write-off, right? Or throw money into mining or agri and basically extractive industries, right? It's a continent where you can build real product, real tech, and solve real problems, right? And make a shitload of money out of it. Excuse my French here, right? I mean, I'm talking, I used to be a very active angel investor in African tech before I started becoming a VC. I can tell you now without disclosing names because it's confidential, but I've personally made between 20 and 30x returns on some of my angel investments. A lot of that has now gone into GP commitments into our funds, but you can make really good returns commercially and see big impact. But the problem here is there is almost selective ignorance and avoidance of this in Western media, right? Bloomberg or the Wall Street Journal would rather write a nice sob story about Africa than talk about the fact that companies like Flutterwave, Move, Andela, Moneypoint are creating massive impact and commercial benefits to the African population, right? I mean, I'll give you a simple example. There's a company called Move, Moove, which is the largest financier of ride-hailing companies in the world, right? So they finance Uber drivers and Bolt drivers that often don't have the money to own their own cars. So they're just making the owners wealthy and healthier. And Move is a company started in Nigeria by two Nigerians that expanded to South Africa and other markets and said, no, we got to change that. We got to make people asset owners. So let's start a financing program in partnership with an Uber and other ride-hailing companies so that we can help these drivers own the cars that they drive, and they'll make sure that the lenders get paid back through Uber, through Bolt. So there's almost zero default rate because every drive is tracked. They've now expanded to Japan, to Brazil, and they've just signed deals as of last year with Waymo. And Move is now financing Waymos in cities like Austin. They're expanding to London now. And this is an African company, right? I can't disclose what the valuation is, but it's a unicorn, right? But very few people will mention that that Move is an African company. They were backed by BlackRock, Uber, and Mubadala in their last round. Flutterwave, similar company that does payments processing all over Africa, right? So it's just a question of changing people's perceptions. And it takes people like the two of you that are doing such incredible work with your podcast to get listeners to listen to how you can create true wealth, socioeconomic and commercial wealth through venture in Africa.
Amazing. Such fascinating journey, such incredible impact. So exciting to hear about what you're doing and what you will be doing for African founders and venture capital in Africa. Zachariah, Mike, and I are incredibly grateful that you took the time to chat with us and wishing you and your team at Launch Africa Ventures incredible success. Thank you, sir.
Thank you. Thank you, Tim. Thank you, Mike. And I'm always available if anyone wants to reach out to us with any questions they have and how they want to work and collaborate with us or our founders.